Okay, today I'm going to show you a trick, a tool, a strategy available to you to save a massive amount of money in the first 3 years of your mortgage. You could take what might be a 7.5% for a borrower today on their interest rate, and they can originate a loan with a 4.5% rate for the first year, 5.5% the second year, 6.5% the third year. It's a massive savings and a massively lower rate. And I'm going to show you exactly how to implement that, exactly how much it saves you, exactly how much it costs. We'll talk about when it should be used. But the reason it's important is today we got non-farm payrolls that came out, jobs report. And this jobs report basically said, hey, we were expecting 160,000 jobs to be added to the economy. Well, it was 256,000 that were added. So the unemployment rate dropped, more jobs were added. And then on top of that, there's a survey that's a consumer inflation expectation survey, and that came out. So both of these things pointing to, the economy is running hotter and stronger than we expected. Well, what that means is the Fed can't cut rates as fast as they want to. So if the Fed can't cut the federal funds rate, interest rates are going to be higher for longer. That means that the price of existing fixed investments like mortgage-backed securities become less desirable. And if you need to sell them, but they're less desirable, you have to lower the price. And when you lower the price, the rate or the yield that those bonds give goes higher. So when you want to sell new ones from new mortgages, you have to sell them at an even higher yield or a higher rate. So all this stronger economy and higher rates for longer stuff is going to push up mortgage rates again. And we can see here, this chart is the 10-year Treasury. And you can see here that the 10-year Treasury yield is going higher and higher and higher. And we have to go back quite a ways. This is October of 2023 to see 10-year Treasury yields this high. So when we look at interest rates and where interest rates were in October of 23, and these track, mortgage-backed securities track the 10-year Treasury pretty darn close. When we see a 10-year Treasury rise, we're going to see mortgage rates rise. We may see mortgage rates get back up into the high sevens potentially. So now more than ever, this 3-2-1 buydown tool I'm going to show you is incredibly valuable. And we know that inflation's not going to stay high forever, but it could take a year, it could take 2 years, it could take 3 years for inflation to come down. So if you want to buy a house today, but you don't want to pay a 7.5% or an 8% interest rate, then you can use a 3-2-1 buydown and give yourself a long runway to be into a house with an affordable rate, and then kind of choose your time to refinance a little bit more strategically. And so this strategy that we're going to talk about, 3-2-1 buydown, this is what the calculation looks like on it. It's a big, huge spreadsheet, and it's based on a certain house, right? So this says a $750,000 house. You could also consider it for a $450,000 house if you're getting 100% financing, or a $550,000 house if you're putting 100 down, right? Same difference. It's all based on the loan amount. But I just want to show you, the reason I picked this number, 750,000, is 450,000 is the median priced home. But right now, the average person with a mortgage in America has about $300,000 in equity. So if you're going to sell your house and move $300,000 of equity over, then maybe you buy a $750,000 house, this is what it might look like. And this is a nice house. This particular one I think is in Winter Springs. So I'll show you a little bit of the interior and a little bit of the pool area they've got here. You've got insets in the ceiling, chair rails, hardwood floors, a lot of square footage on this house, 2,400 square feet. There's another home in New Smyrna Beach. This one's got a killer water view. It's a newer construction, super modern, apron sink, $750,000. This one is in Oviedo. This one was really nice, $750,000, 3-car garage. This is Oviedo Forest, kind of like the Geneva area, killer neighborhood. So all these homes are pending right now at $750,000. So when we're talking about this 3-2-1 buydown and what the cost of it is and what the cost of the payment is, if you're kind of wondering, well, like what kind of house does that buy me? This is an idea. This is Country Club of Orlando, Spring Lake. This will give you an idea of the sort of house that you'll be buying with this type of payment. Most of these are pool homes. You know, they look very turnkey, very move-in ready. You can see they're still selling pretty fast. So this is the kind of house we're talking about right now when we look at this spreadsheet. And that spreadsheet is a lot. So I'm going to break it down kind of quick. We're talking about saving $866 the first year that you own the home. This every month. This is every single month. The second year you own the home, we're talking about saving $600 a month. The third year that you own the home, we're talking about still saving $300 a month. And this is all compared to the payment that you would have if you bought the home today at the full interest rate. So a meaningful savings. And we'll go into the breakdown, but the reason that this has to be employed is we are dealing with this house affordability crisis. And this is a conversation that Peter Thiel had. He's co-founder of PayPal, famous for investing $500,000 into Facebook as one of the early angel investors, turned $500,000 into billions. Co-founder of Palantir, which is a leading defense AI company now. So they're just, Peter Thiel is an absolute genius. So this is a quick clip of what he's saying about what we're seeing in housing right now. And it's going to give you an idea of why this strategy I'm showing you is so valuable.
Is this late 19th century economist who's considered quasi-socialist in the late 19th century. He's considered semi-libertarian in the early 21st century, which maybe tells you something about how our society changed. But the basic Georgist obsession was real estate. And it was, if you weren't really careful, you would get runaway real estate prices. And the people who owned the real estate would make all the gains in a society, because there's something extremely inelastic about real estate, especially if you have strict zoning laws or things like this. The dynamic ends up being that you add 10% to the population in a city, and maybe the house prices go up 50%, and maybe people's salaries go up, but they don't go up by 50%. And so the GDP grows, but it's a giant windfall to the boomer homeowners and to the landlords, and it's a massive hit to the lower middle class and to young people who can never get on the housing ladder.
So, look, it's not just the boomers, right? Even if you're a millennial, it's a massive hit when you see this occur. If you don't own any real estate yet, it's a hit. It's a hit to anybody who's got medium to low equity and wants to make a change. It just locks people in. The only people that really benefit from the current situation that we're in are people that have a bunch of cash paid for real estate. Those are the people that benefit the most. So we're dealing with this massive affordability crisis, and people can't afford to buy homes. Rents are going higher and higher and higher and higher. And so this is the solve for it, right? Like, get in a home today, get in a home for a very reasonable payment, and start building some equity. Get out of the situation where your landlord is raising rents on you every single year, 4 to 6%. Get into a fixed payment, start building equity, look for an opportunity to refinance, and enjoy pretty substantial savings on your mortgage, right? So this assumes there's some big assumptions here. If you look at the bigger, spreadsheet here, we've got $750,000 purchase price, $450,000 loan amount. There's some escrows in here that I took out on the next page. 12 payments a year, 30-year fixed rate, fully amortized mortgage. It assumes a certain credit score, and it's kind of like a middle of the road type of borrower scenario. So, just like with anything you see online, these aren't necessarily your numbers, but they are representative of kind of an average borrower. And so what you're seeing here is that $450,000 loan. So whether you're putting 50 down on a $500,000 house, or you're putting $300,000 down on a $750,000 house, we're talking about $450,000 loan amount. That's how much money you borrowed. You're looking at the first year payment of $2,280 instead of $3,146. So big savings. Year 2, or months 13 through 24, you're paying $2,555, or saving about $600 a month. Year 3, you're paying 6.5%, now $2,844, saving $300 a month. And then at the very end of that third year, month 37, you begin paying the full note rate of 7.5%. You go up to that full payment there. The nice thing about this is that as a buyer today, you can get the seller to pay for this 3-2-1 buy down. So you can actually enjoy this benefit for zero out of pocket potentially. Get a good real estate agent, have them negotiate this as just being part of the contract, seller paid buy down. It's perfectly legal. Get a conventional conforming loan with this. And the nice thing about it is you don't have to wait to go and buy a house because waiting will be expensive. We still don't have enough inventory, right? You would think like, well, with the high rates, people don't want to buy. And so people don't want to buy, then demand falls. And if demand falls, inventory rises. And if you have falling demand and rising inventory, you'll have lower prices, right? But no, that's not true. We have buyers and sellers locked in together right now. So every time the rate goes a little bit higher, yes, maybe there's some buyers that lose motivation to buy. There's also some sellers now who've decided not to list their home. They're going to stay in their current home because they like their current price, they like their current payment. So we're locked in this situation right now where rates can go higher and higher and higher and higher. You only have sellers who are selling who are the most desperate in the marketplace. And so you have no inventory rise and you have effectively no change in the absorption rate and you have no change in price as a result. So if we just assume regular, this is just, let's say, well, what if I wait 2 years and see if rates come down instead of using a 3-2-1 buy down and buying today at a rate that's even below, like even if the best case scenario, let's say rates fell to 5%, you're getting 4.5% today with this 3-2-1 buy down strategy. But, let's say you decide to wait it out. Well, we have modest, this isn't even historical. This is lower than historical appreciation here. This is forecasted appreciation for the next 2 years, not even as high as historical. You would be looking at that same house. This is a $600,000 house. You'll be taking that house. It's going to cost you $46,000 more to purchase it. And you would have saved in monthly payment difference $6,648 a month. So cumulative monthly payment difference for buying now versus waiting to buy. So total benefit of purchasing now, $53,046. This doesn't take into account mortgage interest rate deduction, any depreciation, any other things like that. It doesn't take into account that your rent is probably rising, so it's eroding, some of the difference here, or this is kind of muting some of the benefit. If you have rising rents, then that cumulative monthly payments difference is understated. So this is a solution that if your house is just too small, or it's more house than you need right now, or it's too far from mom and dad, or it's too far from work, or your neighbor's just a jerk and you don't want to live there anymore, or your dream house just got listed and you're afraid if you don't buy it now, you're not going to have the chance. This is a solution, the 3-2-1 buy down, that can get you into the house today with a couple years of a payment that may be lower than any payment you would see even if you waited a couple years for the rate to come down. And by the way, it can all be paid by the seller. Fantastic benefit, fantastic option to use. So hopping over to donharkinsrealty.com. I'm going to post this on our YouTube channel, but we've got a bunch of videos on here about what's going on with the institutional housing crisis and things that are going on with lawsuits and discrimination in the mortgage space. We've got the recent profile of buyers and sellers and everything that's going on with trends where buyers are moving from and why. We've got the Don Harkins Real Estate Show podcast. You can find that on Apple Music and Spotify. Hop in there. And then we've got some featured listings down here. These are great homes everywhere from Merritt Island and Melbourne to Central Florida and beyond, all of Central Florida and the Space Coast. So be sure to hop in and take a look at some of these great homes for sale. We've had some recent price reductions, got some brand new listings. And then, if you have any questions, you can just hit the contact button on our website here, get a hold of me, and let us know what you're thinking, any concerns you have about the market, whether you're looking to have a property be managed, whether you just want to refinance and pull out some equity, whether you need a bigger home, smaller home, or you're moving for work. I'd love to have a conversation with you. I'm Don Harkins with Don Harkins Realty, the Don Harkins Mortgage Team. Please like and subscribe if you're watching this video on Facebook. Thanks for your time today, and I hope this was helpful. If you have any questions, just drop them in the comments or send me a DM. Take care.